All right, let's talk about a financial strategy that gets people really fired up. It's called the infinite banking concept, and it makes some pretty incredible promises about taking back control of your financial life. So, we're going to dive in, break it down, and see what this is really all about. I mean, listen to this. This is the hook, right? This is the question that just grabs you. The idea of firing your banker, earning interest that never stops, borrowing your own money tax-free. It speaks to this deep desire for financial freedom. It sounds amazing, but is it real? That's what we're here to figure out. So, the whole concept boils down to this. Instead of going to a bank when you need a loan, you build your own private system. Think of it like your own personal bank vault, a pool of money that you control, that you can borrow from whenever you want, and that you can pay back on your own terms. Now, you'll hear this called a bunch of different things: infinite banking, bank on yourself, perpetual wealth strategy. But the promises are always the same. And man, they are tempting. A private bank, tax advantages, and this wild idea of making your money work in two places at the same time. It really sounds almost too good to be true. So how on earth is this supposed to work? Okay, let's pull back the curtain. We've heard the sales pitch. Now it's time to pop the hood and look at the actual engine that drives this entire thing. And there it is. The big secret isn't some brand new cutting-edge financial invention. It's whole life insurance. Yeah, that product that's been around for more than 100 years. But, and this is a really, really important but, it's not your grandpa's old life insurance policy. This thing is structured in a completely different way for a totally different goal. This right here is the key to the whole puzzle. With a normal life insurance policy, the goal is simple: get the biggest possible payout for your family when you die for the lowest possible monthly payment. The question is, how little can I pay? But with an infinite banking policy, that entire mindset is flipped on its head. The goal is to build up the cash value inside the policy as fast as humanly possible. The question becomes, how much money can I legally cram into this thing? So, how do you cram more money into it? Well, the secret sauce is something called paid-up additions, or PUAs. You can think of these as a turbocharger for your cash value. Every time you throw extra money at a PUA, you're buying a tiny little chunk of life insurance that's already paid in full. It immediately boosts your cash value, and it gives you a little bump in your death benefit too. This is the main engine of growth. And this chart shows you exactly why that PUA structure is so critical. Just look at the difference in commissions. When you pay your basic premium, the insurance agent can get a commission of anywhere from 50 to over 100% in that first year. It's huge. But the commission on all that extra money going into PUAs, it's tiny, like 3 or 4%. So by designing the policy this way more of your money goes to work for you, building your cash value, instead of just lining the agent's pocket. Okay, so now we get the how. We see how the system is engineered for growth, but let's look at the why. Why are people who believe in this strategy so incredibly passionate about it? What are the benefits they're seeing? You know, this quote from a commenter in our source material really captures the way proponents see it. They don't view it as some dusty old insurance policy. To them, it's a dynamic financial tool. It's like a personal line of credit that you own, you control, and you can use over and over again, maybe even with more guarantees than a typical home equity line of credit. And this is the big one. This is the idea that gets advocates really excited. The concept is that your cash value is sitting inside the policy, humming along, earning a steady, tax-deferred dividend. At the exact same time, you can take a loan against that cash value and go invest it somewhere else, in real estate, in your business, whatever. Your dollars are essentially doing double duty. Now, the little bit of magic that allows this two places at once thing to happen is a feature called non-direct recognition. Not every company has it, but with the ones that do, they promise to keep paying you dividends on your entire cash value, even the part you've taken out as a loan. It's a really powerful feature, and it's absolutely central to this whole concept. And the benefits don't stop there. You don't have to fill out an application or qualify for a loan. Your access is guaranteed. You get to decide the repayment schedule, or if you even pay it back at all. The loans are totally private, they don't show up on your credit report. And maybe the biggest selling point of all, the cash value has guarantees. Unlike the stock market, it's guaranteed to grow every single year and it can never lose value. Okay, that's a pretty compelling argument. But you know, with every single financial strategy, there are always trade-offs. So let's flip the coin and look at the other side, the critic's view, which really hones in on the hidden costs and, most importantly, the comparisons. And this quote from our source material completely changes the conversation. Proponents love to say, "Isn't this better than borrowing from a bank?" But critics say, "Whoa, hold on. That's the wrong comparison. You're not borrowing someone else's money, you're accessing your own money." The real comparison, they argue, is to just taking money out of your own savings or investment account. This chart shows one of the biggest hurdles, and it's a tough pill to swallow: the painfully slow start. Because of all the high front-loaded costs, like the agent's commission and the actual cost of the insurance, a huge chunk of your money gets eaten up in the early years. That means it can take 5, 7, even 10 years or more before your cash value is even equal to the amount of money you've paid in. That's a massive opportunity cost. And this makes the critics' point crystal clear. When you take a loan from your policy, it is a debt. Your charged interest on it may be 5 to 8%. But when you just pull money from your savings account, you're just using your money. There's no interest charge. That cost of interest on the policy loan is a really big deal. Let's just be absolutely clear on this one point. The whole tax-free loan thing isn't some special magic trick. All loans are tax-free. Your mortgage, your car loan, a credit card cash advance, they're all tax-free. Why? Because it's not income. It's debt. You have to pay it back. The idea that this is some unique tax benefit is really just clever marketing. And this number is just startling. The hard reality is that these are really complex long-term commitments, and the data shows that something like 80% of people who buy these policies don't stick with them for life. They end up cashing them out early, and they often walk away with way less money than they actually put in. So we've heard the really compelling case for it, and we've heard the very sharp criticisms against it. And that leads us to the most important question of all. Who, if anyone, is this strategy actually a good fit for? While the consensus seems to be that this is definitely not a tool for the average person, it might make sense for a very specific, very niche type of person. We're talking about a high-income, super disciplined individual, maybe a business owner who has already maxed out every single other tax-advantaged account they have, their 401k, their Roth IRA, all of it. And they have to be someone who prioritizes those guarantees over everything else. For pretty much everyone else, a much simpler approach is probably going to be way more effective. The classic advice: buy cheap term life insurance and invest the difference in low-cost index funds. It's easier to understand, it's cheaper, and historically, it's delivered higher long-term returns. Taking care of your 401k and IRA first is almost always the better move. And really, that's what this all boils down to. Infinite banking presents this very complex system that has some unique advantages, but it comes with really high costs and a slow, frustrating start. The alternative is powerful simplicity, with lower costs and a track record that has worked for millions of people. So the question for you is, what do you value more, that complexity or that powerful simplicity? That's really the key thing to think about. Thanks for joining me.